Taxes can be so confusing, especially when it comes to tax brackets. That's why in this video, I am going to break down for you exactly what tax brackets mean so you can understand how much you're paying in tax. But before we jump in, I'm gonna need you to like, comment, and subscribe so you don't miss out on any of this wealth building information. Now, let's get after it. Tax brackets are progressive, and what that really means is the tax rate does not necessarily apply to all of your income. As an example, if you are, say, in the 27% tax bracket, the first $11,000 of your income will be taxed at like 10%. The next layer up to $25,000 of your income gets taxed at 15%. And it graduates up, it progresses up to the full 27%. So it's really important to understand how tax brackets work. Your effective tax rate is generally lower than your marginal tax rate. Your effective tax rate is literally how much tax you pay as a percentage of your income. So for example, if I am making $50,000 of adjusted gross income or taxable income, and I end up paying $5,000 in tax, I am paying 10% would be my effective tax rate. That's different from your actual marginal tax rate. Your marginal tax rate is the tax bracket that you land in based on your overall gross income. So it's really important to understand effective tax rate, tax brackets, and marginal tax rate. Deductions lower your taxable income. So it's very important that you understand that. If you are going to take the standard deduction, which IRS updates every single year, they modify the standard deduction. If you're going to take the standard deduction, and let's say the standard deduction is going to be $12,000, and let's say that your income is $48,000. If you were able to take the standard deduction and you were able to deduct $12,000 from $48,000, that's going to lower your taxable income and put you in a lower tax bracket. Therefore, the tax bracket that you're going to end up in is going to be after your actual tax deductions. Tax credits are even better than deductions. Deductions lower your taxable income and determine what tax bracket you're going to land in. But credits actually reduce the amount of tax you have to pay dollar for dollar. Let me give an example. Let's say that you are eligible for the child tax credit, and let's say that credit is $2,000. If your ultimate tax liability is $20,000 and you apply the $2,000 tax credit, that reduces your tax liability down to $18,000. That's why tax credits are so important, and there are so many different tax credits based on the niche that you are in. For example, if you have children, if you have childcare, if you own a logistics business, if you start up a retirement plan, there are so many different tax credits that you can use to lower your overall tax bill. When you are thinking about lowering your overall tax bill, the tax benefits of having capital gains rates and the tax benefits of having the dividends on your tax return is really going to help you. When you have capital gains, and those capital gains are long-term, as an example, you may be able to drop your tax rate on that capital gain down to the 10% tax bracket. Remember, a capital gain is where you sell a capital asset. For example, you sell an asset like stock or a home that you held for longer than a year. That's a long-term capital gain. A short-term capital gain is anything less than a year, and that's taxed at ordinary income tax rates. So to be efficient, you want to try to get income coming on your tax return as dividends, which puts you in a lower tax bracket, or capital gains rates that puts you in a lower tax bracket if it's long-term capital gains. The real purpose of tax brackets is supposed to be fairness, that tax brackets actually progress as your income gets higher. However, if a person says they're in a 27% tax bracket, the highest bracket, realize that they have escalated up to the highest bracket. All of their income is not going to be taxed at 27%. Allow me to give you an example. If you have an individual that say is making $150,000 a year, they would be in a 27% tax bracket. However, is all of the $150,000 going to be taxed at 27%? Absolutely not. Remember, you're going to fall into your tax bracket based on your filing status, whether you're single, head of household, married filing joint, or qualifying widower, and based on the amount of money that you make. And it's going to be gradual. So for example, your first $11,000 is probably going to be taxed at 10%, and then it escalates from there. So just remember, tax brackets are set up to make sure that everybody pays a fair amount of tax as their income escalates. In addition, you guys asked me a lot of different questions in the comments, so I want to answer some of those questions. You want to know, do tax brackets change every year? Typically they do. IRS makes adjustments to tax brackets typically every year as they do standard deductions and other items. So yes, they do. And the highest tax bracket is generally 37%, that you will find someone is going to pay that as the highest bracket. But remember, only a portion of their income is going to be taxed at that rate. So it's so important that you now understand tax brackets is where you land based on your overall income, and all of your income is not taxed at that bracket. Your effective tax rate is the amount of tax you actually pay as a percentage of your taxable income. Your marginal tax rate is the rate that you're going to land in terms of the bracket that you fall in and the tax status that you are in. Remember that deductions lower your overall taxable income, and tax credits reduce your overall tax liability. And capital gains rates and ordinary dividends are always taxed at a lower income tax rate. At the end of the day, when you know better, you can do better. It's so important that you stay on top of what is happening in the tax world, because that is your biggest expense, is income taxes. So now that you know all about tax brackets and effective tax rates and how to get your tax rates down, you need to be paying attention at all times, because taxes are changing at lightning speed. So make sure that you are paying attention as well.